Welcome to another edition of the Savant Investor. Please support us by subscribing. What is a CD? Short for Certificate of Deposit. A CD is a type of savings account offered by banks and credit unions. Funds in traditional CDs are tied up for a set period of time in exchange for paying a certain amount of interest. Usually, there's a guaranteed rate of return. Long-term CDs typically pay higher yields than short-term CDs. To earn a higher yield, you usually have to open a 4-year CD or a 5-year CD. But in the current low interest rate environment we're in, opting for a long-term CD may not make as much sense. Why would you get a CDs? CD are a low-risk place to stash cash and get a guaranteed rate of return. That makes them good investment for shorter-term goals, like saving for a new car or for a down payment on a home. CD yields are also low compared with what you would earn by investing in bonds or putting your money in the stock market. To earn a higher rate of interest, you have to aim for a riskier investment. There are many types of CD. Traditional CDs. They feature a fixed interest rate and fixed term. You'll get hit with penalty for withdrawing your money early. No penalty CDs. These CD, also known as liquid CDs, offer the ability to withdraw money without a penalty. They may have a lower rate than traditional CDs. Jumbo CDs. These CDs require a larger deposit than traditional CDs, often of $100,000 or more, and they can pay more than traditional CDs. Bump-up CDs. If rates rise during the CD terms, bump-up CDs give you the option of asking the bank to increase your rate. And then step-up CDs, like bump-up CD, step-up CDs offer the ability to increase your rate in a rising rate environment. The difference is in that step-up CDs offer automatic increases at certain intervals. Zero-coupon CDs. Similar to bonds, you purchase a zero-coupon CD at a discount to its par value, or the amount you will receive when the CD matures. Callable CDs. While they may provide higher yields than traditional CDs, there's a risk. Callable CDs can be called back by the bank before the CD matures. IRA CDs. These CDs are held in an IRA. Add-on CDs. Unlike many other CDs, add-on CDs allow you to make several deposits during the CD term. Pros and cons for CDs. There are several benefits to investing in CDs. There are also some downside. Let's start with the pros. The safety. CDs are insured at Federal Deposit Insurance Corp. up to $250,000. Predictability. You get a guaranteed rate of return. Higher API. CD generally offer higher API than traditional savings. Option. There are several different types of CDs for various needs. Availabilities. CD are widely available from traditional banks and credit union. On the contrary, cons. Liquidity. CD lacks liquidity, requiring that you lock away your money for a set period of time. Penalties. CD often have stiff penalty for withdrawing early. Taxes. You pay taxes on interest that accumulate in your CD. Risk. Some CDs, such as callable CD, are riskier than other type. Lower term return. CD don't offer return as high as some other investment. How to build a CD ladders. If you purchase multiple CDs at once that mature at different times, it's laddering CDs. It is a strategy that can reduce risk and allow an investor to always have access to cash because they regularly have CDs maturing at set intervals. As an example, let's say you want to build a 5-year ladder with 5 rungs. If you have $10,000 to invest, you could place $2,000 in each rung. It would look like this: $2,000 in 1-year CD, $2,000 in a 2-year CD, $2,000 in a 3-year CD, $2,000 in a 4-year CD, and $2,000 in a 5-year CDs. When your 1-year CD mature, each of the other CDs move up a year in maturity. That means that your 2-year CD would mature in a year, your 3-year CD in 2 years, and so on. One way to extend the ladder even further is by rolling the money on a city that just has matured into a new 5-year city. You can continue that pattern by purchasing a new 5-year city each time a city matures. Investing $10,000 in city maturing in 1, 2, 3, 4, and 5 years will give you more interest than continuously renewing a single 1-year city over a 5-year period. You create a city ladder by purchasing a 1 year at 2.65% APY, 2 year at 2.8%, 3 year at 3%, 4 year at 3.1%, and 5 year at 3.15%. The result, your ending balance after 5 years will be about $11,663 versus $11,417 for a single city over a 5-year period. And you have access to some of your cash each year if you chose to.
City laddering when inflation is rising. Laddering cities and keeping your term length short can help when you're concerned about inflation. But in the long run, that's not enough. Even among the most conservative investor, putting all your asset into cities or bond isn't a good idea. In fact, avoiding risk by choosing only fixed income investment is actually risky. You are actually putting themselves in many ways at more risk than someone who has some of the portfolio allocated to the stock market, which traditionally respond relatively well to inflation over time. Even for risk-averse investor, it's best to properly diversify.